Hello everyone. My name is Shubhajit. I'm the host over here and introducing you to Rohit Srivastava. He's a very renowned name in the market, as you guys also know. So, let's talk about the market today. Okay. So, today we will be decoding the market in just three questions. Sir, to you, just what was the like, what was the market today as per your analysis and all?
Yeah, great. So for everyone to know that you just thought of starting off this series to try and decode things. It's not just about what the market is doing today, but any kind of random questions on what we face as investors and traders every day to really to get to the crux of subjects around behavior, around managing trades, around managing investments. And if you have questions related to that, do put them out. So we will always have a backup. Three wild questions that Shubhajit is going to throw at me and do the wonderful job of hosting. So today's market. So you wrote something to me about what could be around the discussions, and today's market is actually one of those where in the last few days the market actually was trying to break out above 25,000. Okay, and its attempt to break, will we stay above, not above, becomes the question. Somehow today we've managed to stay there, but when we actually look at the broader index like Nifty 500, which has gone a little further, it looks well above. Now the question is, what if we go back below 25,000? So then what happens is we end up calling this a false breakout. Now today all the indices except Nifty have closed in the red. So again, that's a tricky part. We have to try and understand whether this is just a temporary one-day scenario, because many times you get this one-day dip. It looks like, oh, it's all over, and then it will just continue going higher tomorrow. Now, have we broken down enough to say that it's a trend reversal? The answer is no. But I have some red flags, not all. So I'm faced with this contradictory situation where some things show that okay, we got a little high on breadth. For example, we look at the breadth indicators and they tell us like, okay, a lot of things went up too much. But there are some others which say in the medium term we have a long way to go. So this is the conflict we are trying to deal with, and the answer to me came, let's just watch what we do at 25k. If we sustain above this 25 to 25,080, this is the zone, then we are still all good. But if we don't, then we could have some kind of a short-term correction, knee-jerk reaction. In fact, I put out a couple of posts while you were setting it up, and I didn't come online. I was busy writing. There were a couple of divergences in global indices also over the last week or two, negative divergences. So there is this slight risk coming up that there could be a corrective knee-jerk reaction in the market. But in Nifty, we didn't get any confirmation today. That's the only thing. But that's what I started to consider. So we can see that weakness in the breadth. Will it translate into a correction in the next few days? Is what I'm going to be watching out for. Long answer.
So going forward, as we talk about breakouts and all. So for retail traders, like they get like very excited by just listening that there's a breakout or something like that. So what's the process to verify the breakouts? Can you just walk us through it step by step and also apply it in a real life scenario?
Yeah, that's a good one, and we all face it, including me on a day-to-day basis, and it takes some time, some amount of time and experience for people to know that they have to deal with their emotions in this situation. We try to anticipate breakouts, so this anticipation really happens because we are looking at a combination of Elliott wave analysis and the sentiment indicators that we now have made available to people on strike. So that combination allows us sometimes to anticipate them. And the thing we have to do next, so what you're talking of is correct, that people get excited on the breakout. Now buying breakouts, which probably had some history, actually fails more often than not, because a lot of people get trapped on several breakouts that they're looking at. So sometimes if it also has to do with not drawing the trend line properly. I have found moving averages sometimes better at holding out on breakouts, but There can sometimes be whipsaws even on moving averages. End of the day, you can't just go and chase. So the point is that you should not be chasing price. Breakout is a confirmation of the trend. So let's take the current scenario. Best example is to what is happening over the last 3 days. We gapped right above the 25,000 mark and closed above it. Okay, 25,100 on Monday, and then we're trying to hold above it. Now, moment it did that, I'm very excited. Fine, this is broken out, and I have a wave count that can be super bullish, and we end up marking 1 2 on the chart and say 3 of 3 hoega. Last few days, I've been doing these channels on these short videos that we have been posting on X, and we like draw a channel and it says 25,700 super bullish. But today I actually questioned it. I said 2 days we stayed above the breakout mark and the upward trend is not showing continuation of that momentum. And this is where then you get cautious. Even though you have a breakout, you need to be cautious of the idea that it can be a false breakout. Now, how would you know that it's false or not? On the Elliott wave side, it means having an alternate wave count that gives you that scenario. Sometimes you don't have an alternate wave count. It's where the setup is very good. Then you don't consider the alternate. But if you do, then that is one warning. Okay, fine. This is also possible. And the second is back to sentiment, right? That's what we said in the beginning, that if there are certain indicators that are getting overbought, then we try to consider whether something can go wrong at this point of time. So one of them was the 40-day advance decline ratio. Okay, the breadth essentially in this market has been very strong because mid and small caps have gone up rapidly and the large caps have not participated. But even then, the participation of the broad market has driven the 40-day AD ratio right to the top end red line on our breadth chart. I don't know if I should share that. Very quickly, I could actually do that for people. So here, this is the 40-day average of the advanced decline ratio. I'll move to a white chart for those it's more clearer. And when it reaches this top red line over here, okay, we are sort of at this red line. We are sort of getting slightly overbought here. Okay. Now, sometimes the markets can react immediately to this overbought reading. Like here, it was also close to overbought. You got a sideways consolidation. Again, you're there. And sometimes the market may move higher with some divergences before correcting. So you can have both kind of scenarios. But it is a scenario. So you have to think, like here, you got well above the red line. Then it did correct, and then you had a even bigger correction later on after some more attempt to move higher. So that is where we are gotten here. We are above the red lines, and it's a warning of sorts. Okay, so I've now shown you what is a warning. So while there are some positive signs that okay, if I is a short, they may still cover, but here's another indicator which is a warning. So then, while we can get overexcited, it's broken out above 25,000. Now we should go to 26,000. We should make an all-time high. Something comes up and tells you, wait, be careful. As a trader, be careful. For the investor, it may not matter because a short-term correction, consolidation, 200 point girega makes absolutely no difference. But to the trader, and especially an options trader, it can make a lot of difference because you lose time value. Okay. And that's a big loss. And if you don't get immediate action, so for options traders, big loss. For the directional traders also, there's an M2M factor, right? And especially if you're buying on the breakout, then all the more risk. Now, very similarly, we would use these data points when they are at the extreme lows to anticipate that can a possible move start on the upside. And we had one such indicator a week back. So again, I'm going to share it. Hopefully, that's the last share I have to do, but who knows? And this is on our diffusion indicators. We had the percentage of RMI buy signals. RMI is our own proprietary momentum indicator. How many of them are in bullish mode was being measured, and this came down to 10%, right at the bottom red line, second red line here on the 3rd of June. So this is why, this is one day before the RBI policy. So people need to understand that if they heard me online and they heard me in our daily video updates, on social media mentioning that it will go up, it's essentially because we get something like this, where you've reached an extreme and everybody's everything is showing that it's too negative, so it possibly will not remain negative, it will turn positive. And then we take a contra view there, so we end up anticipating the breakout. So when you anticipate the breakout, the advantage is that one is that you bought at the low, okay, and then it's easier for you to decide whether this is a false breakout or not if it falters at 25,000. Now if you buy after 25,000, you don't have a lot of room. If tomorrow it gaps down, what is your room to manage risk? Very, very little. So that's why you need to be a little careful. Don't chase breakouts. Hopefully you have a method that allows you to anticipate them, and then you have room to manage risk. Because risk management is then takes over. You should have the trade entry has to be right, and then it has to be risk management.
So you just answered my second question. It was just like if a trader misses a breakout or entry, is it better to chase or wait for a retest? Like how you decide, and you just answered it.
Yeah.
So
Yeah,
moving
no,
on
so
to the
that
next
retest,
question.
so second part I don't think I answered, which is a retest. So this is interesting. And the next 2 days is really going to be about that. So we are above 25,000. Now, say for example, we do fall tomorrow. We fall to, so even if we fall below 25,000, say to 24, 950, it's possible even then we recover, and come back above 25,000. So it can also be a reverse, it can be a double false. So in this window, you need to just give it time. Give it 1 or 2 days. See whether the fall accelerates on the downside, or does it end up becoming a temporary pullback on only a retest of the breakout point. Now, how you decide a breakout point also becomes critical. So there are two ways. One is that you just take the high. So the previous swing high was 25,080. But another thing I did yesterday or today in the videos, I drew a downward line of the last two highs. So then it's not 25,080. The number will come down slightly to 25,000 something, And sometimes what will happen is market will dip back to test that trend line, take support on it, and then take off from there. So it does happen. Retesting of support is also a function that sometimes happens. Now, sometimes you also break out and run away. You don't even wait for a pullback. And that is why I say I give that importance that entry has to be right. Hopefully, you have identified it in advance, because then you don't have to wait for that. But yeah, if you do get a pullback, and if you've not bought before and you got a breakout and you get a pullback, then the pullback can be a good entry opportunity for someone who's missed it. But wait for the support to be proven that yes, it did not go back below the breakout point and it turned positive from there again. That would be your signal to make a second entry over there.
Well, sir. So moving on to the last question of today's series, like, can sentiment indicators really reduce emotion in decision making in breakout? And can you please explain on this?
Yeah, no, yeah, this is the toughest one. We hope that indicators will reduce our emotions, but emotions are very, very human. Your emotions are not going to go away. So when I get a breakout above 25,000, even I think, yeah, should I ignore the indicators now? Because what if it is a trending move? In a trending move, we all know overbought conditions remain overbought only, or market bhagta jata hai. So then this is a critical decision making point. So which emotion should I follow? Should I say breakout hai, ignore the indicators, or should I say no, the indicators are telling me it might pause and I should give it up over here? This is a dilemma, and there is no solution to the dilemma except what we call as trade management. Now, trade management can mean one of two things. Either, like now I mentioned 2-3 things before, so let's just summarize. The first one is, did you make an early entry? Okay, so that is one way of trade management. Second one is, even if you did make an entry or you didn't make an entry, if you're holding on to a position now, what should you do now that some sentiment indicators telling you that you could have trouble? So this is where we call it as risk management. The mental ability to either reduce your position, okay, to a amount where you may not be bothered by an overnight reversal, or to be able to exit and re-enter once again. Okay, and I strongly use the RMI cycles to do that. Now, what do I mean by that? Probably have to share it all over again. And this part of the school that we do when we teach people how to use RMI, this part of the schooling, and how it really helps us in discipline. Because the whole idea of your question, as I understand it, is how do we become disciplined, right? How do we use how do we get over our sentiments and emotions with some tool? Now, one of the tools is here, it's in front of you, and that's the Rohit momentum indicator, right? The RMI that we are referring to, which is the basis of a lot of our buy sell signals. Now, I look at the RMI as a sine wave. It's something like this. It goes up, it comes back to zero. So it's one sine wave when it does this, when it completes a cycle back to the zero line below this dotted line over here. Now, in this case, even as prices have continued to move up here, and there's a negative divergence and we are looking at an hourly chart, this cycle is not complete. It's not come back down. So what I would do here is I would simply say this is my signal for patience. I'll trade manage this cycle, which means that as long as we are doing this, I'll give importance to the overbought sentiment indicator. Okay. However, once it's down here, and or if it triggers another buy signal after that, okay, so that means I will end up having a second average which crosses it. That is when I will look at re-entry. So it's sort of an exit entry kind of. So if I'm doing exit and entry, I want to risk manage, or I want to reduce my position and add it back. Then on a lower time frame like this, I would use this cycle as a exit and entry point. So this is where the risk management really comes in. Okay. So very powerful tool, what we call the cycle. I don't think people always understand the importance of the RMI cycle. It's not just about buy and sell. It's also a huge disciplinary tool. So if I didn't enter a particular trade, and I missed the cycle, it's up. Let's say, fine, I missed it. My mistake, I was not on the desk. I'll take the next cycle. Because I don't want to get in and chase a market, buy it 10% higher and then get stuck. The idea is to buy at the right time. So if you missed it, you'll have to wait for the next time, which could be at a higher price even, but you have to have that discipline of waiting for the next time. Else, make sure that you're there the next time a trade setup shows up. The next time you have a sentiment, momentum, Elliott wave setup that is perfect, you wanted to trade it, you better be there. And that is why the market requires your attention all the time. It requires you to be there and show yourself. Show up. Just like you have to show up for work every day. People go on a job. You have to show up for the market. Market will not reward you for not showing up. So you better show up and you better do your study. And if you do it, you will be rewarded. If you don't, it will pass you by. And then you say, "Arey yaar, wo to tha, maine liya nahi." That is going to be the situation.
That's also these were the three questions for today's market decode, and it was great. Like it was great. Thank you, sir. Uh, so there are some comments popping around. So is there any? Sorry, let's wait for 2 minutes, like for
Yeah,
any questions.
surely.
You
If there's
guys
anything
can,
interesting.
yeah.
And guys who see this video later, you can also post questions which we can, consider next time. So you got an hang of, what we really want to discuss in these sessions.
So Deepak is asking a question regarding macro developments.
So I told you that is going to be the case. But Deepak, wait out for the markets and nonsense that I do with Chavan probably tomorrow, day after. That is when we discuss only markets and sectors. So wait for that, or join us on the weekend with Indiacharts, where I talk an entire length on many of these subjects. So we are trying to, discuss things outside of that over here.
So next, Ajay has a
So
question.
20-day crossover, 50 days HME in 2-3 days, then a backward step into 24,800 and rerun from there. Is this a possible scenario? Yes. So this is another fall. So what he's talking of is possibly another kind of fall signal. And it's very interesting. But I found that these, fall signals from the moving average crossovers, they essentially happen in bear markets. Okay. And so in bear markets, you get false buy signals and the market tops out and rolls over. In a bullish market, more often than not, once you have a crossover, it sustains for weeks and weeks. You don't get another cross. So it becomes trending in nature. So finally it comes down to what is your view on the market. Is it bullish or is it bearish? And that is how the indicator behaves. Now I'm completely turning this discussion on its head. Rather than saying the indicator is telling me something, I'm saying my view on the market tells me how the indicator is going to behave, and that then pushes you to get a view on the market. And how do you get a view on the market? It's going to be a combination of sentiment and Elliott wave again. Now, sentiment we can observe on our tools. Elliott wave analysis, of course, requires some learning, and that is where I would push people to really consider the Indiacharts mentorship sessions. We're starting another batch in September. Consider it to learn Elliott wave analysis, because that's when you can anticipate, market trends, or at least get a broad idea that yes, this is an uptrend that's going to be around for the next 6-8 months. Then this is how the averages are going to behave, and therefore then this is how I will react to the behavior of the averages. So my entire discussion completely changes from, oh, the averages crossed and given me a sell, now what do I do? It's a death cross, now what do I do? No, it's not a death cross. My view determines whether it's a death cross or not. So you need to get a way of knowing what the right view is.
Right, sir. So that's all for today. Thank you, sir.
Thank you
Thank
everyone.
you.
See you all next time. Thank you.